Who's Catalyst Financial Group. We were founded in 1994. We've been doing this for a very long time. We've worked with over 25 different electric and gas utilities throughout the United States and setting up financing programs for the utilities, for their clients. We've worked as financial advisors to both the EPA Energy Star program as well as the Department of Energy. So we've been doing this for a while, and I'm happy to share with you some of the experiences that we've collected during the years about how to make things work and work better. I'd like to start with the learning objectives. And I'm going to be discussing, and this is really where our presentation started a number of years ago. It's really evolved a lot because the financing community has evolved. So we have been updating these slides. So every time you come back and hear one of these presentations, even though it might be my presentation or somebody else who's substituting for me, the information that's contained in the presentation is always updated. We try to keep it as current as possible. So we're going to talk about 8 different financing options, probably the most common ones used in energy service performance contracts, loans, capital leases, operating leases, tax-exempt lease purchase financing, and this is really a powerful tool if you're in the public sector. I will be talking a little bit about power purchase agreements, energy performance contracts, ESAs, and energy service agreements. In addition, and this is a big addition to our talk, we're going to be introducing the Inflation Reduction Act programs. Now, the Inflation Reduction Act is very complex, and it's not totally determined at this point. There are constant upgrades and updates being generated by the Internal Revenue Service, for example, on how to deal with some of the benefits that are coming. So I'm going to give you a quick overview of the 179D tax deductions, the Section 48 investment tax credits, Section 45L, the new energy efficient home tax credit, and Section 5121 home energy rebate program. So if something tweaks your interest there, I will give you some links as to how you can drill down further. But I just want you to get a feel for what the program is. And if it sounds interesting, there may be some great opportunities there to reduce the overall cost of your energy efficiency and renewable programs and projects. I will be talking about some of EPA Energy Star's financing tools. There's one that I have a particular love for, which is the Energy Star Cash Flow Opportunity Calculator. The reason for the love is that I'm one of the developers of that tool. And what it does is it calculates and demonstrates the cost of delay, which is something most people understand intuitively. Excuse me. But if using this tool will help you put numbers to it, it will quantify it. And I can guarantee you that there are conclusions that you will come to after using that tool that most of your financial people with your clients or within your organizations will not take into consideration. They're just counterintuitive conclusions that the tool underscores. So with that, first things first, always an important step. So what are the first things? Let's talk briefly about today's economy. I wish things were better. Right now, of course, we continue to have delayed installations. There still continues staffing shortages. Supply chain still continues to be a problem. Inflation is killing the production cost and labor costs. So that's pushing up all of our underlying costs. The higher interest rates, of course, make financing more expensive. And the reality is that the impact on energy saving, the lagging utility rates tend to require longer financing terms than under normal circumstances. The reason being that the savings that you generate because of the lag could be less than what would be needed to accelerate the repayment of the financing. And of course, the IRA is providing new financing incentives, and that is a very exciting piece of today's talk. But before deciding on financing options, let's talk about your first step. Your first step should be getting an energy assessment from a qualified service provider. Different technologies lend themselves to alternative financing solutions. So you really need to understand what you're going to be installing before you start drilling down on how to finance it. Because as you will see, different structures lend themselves for alternative projects that you would be installing. Of course, you need to define your short and long-term business goals. Do you own or lease your space? If you're leasing it, you certainly want to think twice about entering into an agreement that goes beyond your lease because you may be growing or reorganizing, and you may need more or less space in the future. And of course, that involves forecasting future cash needs. So the third bullet here is understanding your financial profile, because when we are in the world of lending and borrowing, you need to understand how a traditional lender would look at you, how they would score you, because that will in turn give you some guidance as to where you need to look for alternative financing sources that will be giving more credit or more value to the project, the energy efficiency project, or the type of organization that you are part of. And of course, the great place to start always start with your utility, asking them what's available, your local, state, and federal governments, and of course, you will see, because I'll mention them numerous times, your state energy office. They're a really critical piece on where you can find your money. And as you can see here, that's my lead-in, NASIO, National Association of State Energy Officials. Click on that link. You're going to get a copy of all the slides, so you don't have to take copious notes right now, but just click on that link. It's going to give you a map. Click on your state, and that will bring you right to your state energy office. An alternative place to look is Zero USA. It's a database of state incentives for state and federal incentives and local incentives for renewables and energy efficiency. It's managed by North Carolina State University, and I'm going to have to modify that slide a little bit because it's not limited to state. It's state, federal, and local. And before seeking financing, understand the benefits and the consequences of the different financing alternatives. And that's one of the reasons why you're with us today. So let's take a quick look at the Inflation Reduction Act. Some of the key takeaways. Well, it's a huge number, $891 billion, of which $783 billion is going to be invested in energy efficiency and climate change. There are some really big changes in the world today with regards to getting paid. One of them is the direct pay option for tax-exempt organizations. If you were a tax-exempt organization in the past, you could not take advantage of any of the tax benefits, tax credits. You couldn't do that because you didn't pay taxes. Well, guess what? That's now changed. Now there are direct pay options. Tax-exempt organizations can benefit from these tax incentives that before were not available to them. Part of the benefit is the ability to transfer some of the tax credits. So you can transfer them and you can monetize them. So you can convert them into dollars. Get the federal government to pay if you're in the not tax exempt world, you may be able to get the federal government to write you a check. And of course, there are new tax credits for different technologies that have expanded the list of technologies. So I'm going to start with Section D, and that is really the energy security piece. The tax credits and deductions were to promote private sector investments in clean energy technologies and reduce CO2 emissions. I mean, that's the driver here. The changes in the federal tax code to help the U.S. real estate market and reduce the carbon footprint is a big driver. There is a deduction to help make commercial and multifamily buildings more energy efficient. That's under Section 179D. I'll give you more details in just a second. There's a tax credit to encourage investments in renewable energy generation, storage, and other clean energy. That's Section 48. There's a tax credit to incentivize the installation of EV charging stations. That's Section 30C. I'm not going to drill down too much on that because I'm really more focused on the 179D and Section 48, which I suspect, based on who's the audience that I looked at the list of attendees, might be more interested in. And of course, there's a tax incentive to incentivize energy efficiency new residential construction, 45L, and the homes rebate program, which is being handled basically through your state energy office. So let's start with the 179D tax deduction. It expands the 179D deduction for architects, engineers, design build contractors, and other designers of tax exempt buildings for both buildings that are owned by government and nonprofits. Big change. You weren't there before. Building owners, commercial and multifamily. Big change. REITs and residential building owners. Big change. In the past, REITs could not take advantage of these tax benefits because of the way they're financially structured. Now they can. Building owners, you have to have a property of 4 stories or more in order to qualify. What are the benefits? Well, the benefit starts at 50 cents per square foot for energy savings of up to 25%, and it will go up to $1 per square foot when you get your energy savings to go up to 50%, and that's a sliding scale. So, it's not locked at 50 cents. If you get up to 30%, that's going to bump up and you can make it all the way up to $1. However, there is a bonus that you can qualify for, a 5 times bonus, if you have prevailing wage and apprentice requirements, and which could be a little complicated. And qualifications of the retrofits are reduced. So they've got a decrease in the energy use intensity from 50% to 25%, which makes it easier to qualify. And there's a requirement. The requirement for energy simulation model has been removed for retrofits. There are basically 2 methods to qualify for UBAC 179D, and one of them is the whole building energy simulation model, which does require a modeling. The model must be approved by EPA in order to qualify. And the alternative way is the retrofit alternative method, which does look at lighting, HVAC, and building envelope specs as well. Now, another big change here, because in the 179, you did have the ability in the past to take that deduction, but you could have done it by lighting alone, HVAC alone, or building envelope alone. That is no longer the case. Now you have to look at all 3 of those components in order to qualify for the actual deduction. And there are other ways in order to bump that up by Buy America considerations, etc. So if that's something of interest, send me an email or something later. I can give you a little bit more detail. What is Section 48 investment tax credit? Well, what is it? It's the 6% of the cost of the energy property, the base rate, which can be scaled up to 30% of the overall cost, which is the bonus rate if the project pays prevailing wage. And that's become a driving force here, prevailing wage, in order to maximize the benefit of these rebates. So it would go from 2% to 10% right off the bat, and you can bump it up even higher by, as I alluded to earlier, Buy America, depending on the location of the property that you're working in, et cetera. You can bump it up considerably, which is the good news and the tricky part, because I think what we're seeing right now, it's not that easy in order to qualify for the new 179D or some of the tax credits, especially the 179D. So getting back into the microturbines is limited to 2% base rate that goes up to 10% with the bonus rate. Credit transfers are allowed to third parties. That's a huge plus. Companies with little or no tax liability cannot typically benefit from tax credits like REITs, which I had alluded to earlier, but they now have the option to transfer credits to another tax-paying entity that can use them as long as it's not a related tax-paying entity. So that's a huge bump. This is all driven to increase the installation of energy efficiency and renewable energy projects within the commercial real estate arena. And that's especially important when you consider that I read a study that I think 75% of all property right now was built prior to the current century. So there's a lot of old properties out there that will benefit greatly for doing these improvements. And of course, the investment tax credit, as I had mentioned before, can be refundable for tax exempt entities. That means you can get a check directly from the federal government. Take a quick look at the 45L new energy efficient home tax credit changes. They've extended the rules through 2032. It began beginning this year in 23, new homes certified under the Energy Star program were eligible for a $2,500 tax credit. And it's important to point out there's a difference between a tax credit and a tax deduction. 179D is a tax deduction. It is not a tax credit. So all you can deduct the amount of the investment when you calculate how much tax you owe versus a tax credit, which is actually fungible. It's money that you can actually spend by paying tax obligations. So for dwelling units certified under the Zero Energy Ready Homes program, the credit is increased to $5,000. For multifamily units, base qualification is decreased to $500. However, it's per unit. The Zero Energy Ready Homes program bumps that up to $1,000. But if the family units meet prevailing wage requirements, they will receive an increased $2,500 credit for the base qualification and $5,000 for Zero Energy Ready homes. Section 5121, Home Energy Efficiency Rebate Program. $4.3 billion from the Department of Energy has been earmarked to award and to grants to state energy offices. The state energy office is charged with developing and implementing a homeowner managing energy savings rebate program, and 50% plus of the funds will go to households with incomes below 80% of the area median income, which means 50% will be not for incomes below and 50% above. Single multifamily homes, the home energy rebate program will reduce the upfront cost of the whole energy efficiency upgrade. And of course, home electrification appliance rebate program reduces the cost of the technologies that you're installing. Rebate provided under a homes rebate may not be combined with other federal grant or rebate programs, and this will carry on through September 30, 2031. Green banks. Green banks received an injection of capital as part of this. And green banks, if you're not familiar with them, they're mission-driven institutions that use innovative financing to accelerate the transition of clean energy to fight climate change. And that's a definition from the Coalition of Green Capital. They're the ones who really are one of the founders of green banks in the United States. They use public capital to mobilize private investment. There are currently 23 banks in 17 states, DC, and there's more under development. If you're interested in finding out more, I would suggest you go to the Coalition for Green Capital website, and there's a wealth of information there for you. The IRA, Inflation Reduction Act, provides $27 billion grants from the EPA to establish a greenhouse gas reduction fund, which obviously provides some of the funding for it. Now, why do I talk about green banks? Because they're not limited to making loans. They can do a variety, they provide a variety of services to you. They could potentially provide loan guarantees. They can co-lend. If you have financial challenges because of your credit profile or the audience or the arena that you're working in, I would strongly suggest that you reach out to one of the green banks if you're fortunate to have it in your state. And they can really help you, especially if you're dealing with the low-income disadvantaged communities. Cannot forget to mention the Infrastructure Investment Jobs Act, even though that is beginning to fade away in terms of the Section 179D. That's being eliminated through the Jobs Act. However, the Green Water State Revolving Loan Fund continues, and that's $23.4 billion of federal and state partnership funds to provide low-cost financing for water quality infrastructure projects. And as you can see, I'm not going to read the list there, but if that's something of interest to you, that's a standalone program that's been around for a while. It's just been injected with some fresh capital. So now let's take a look at the more traditional financing alternatives. Now that we've come out of the IRA section. So we're looking at financing structures versus sources of funds. The IRA deals kind of more with the sourcing of funds rather than the structures. So you may wind up borrowing money through a green bank for a particular financing deal, and that's why this part of our presentation today becomes important, because there are many different ways to finance these projects, some of which lend themselves more to the technologies that are being installed, as I had mentioned earlier. Here's a quick map of the different types of financing structures that are available. Obviously, as you can see on the right side over here, a little arrow. If you're doing internal funding, it's academic. If you're floating a bond, I'm not going to be talking about bonds today. That is a subject of more than an hour and a half presentation. That is a very in-depth area. I'm going to really focus more on the more traditional and, of course, the specialized financing options that are unique to energy efficiency and renewable energy. Under the leasing, there's a type A or a capital lease, type B, an operating lease, and of course, the all-time favorite for people who don't pay any taxes in the public sector, the tax-exempt lease purchase financing. And loans, consumer loan, commercial loan, very familiar. However, a lot of the financial institutions are now offering equipment financing agreements. Why? It's very similar to a type A capital lease. These all go on the balance sheet. Equipment financing agreement, it's a conditional sales agreement that also goes on the balance sheet of the borrower. So there's a very simple crossover between those two. From an accounting perspective, they have pretty much the same impact. Under specialized lending, solar leases, they're a unique animal. They're extremely negotiated, and it's really hard for me to say there's one size fits all, one size does not fit all. Loans from the specialized side, the utility OBF, on-bill financing, and OBR, on-bill recovery. They tend to be below market programs, so if your utility is offering them, take advantage of them. OBR, the difference is OBF financing, that the utility is using their own funds for underwriting the projects. And OBR, on-bill recovery, they have an agreement or a relationship with a third-party lender, and they are basically servicing the financing for that third party. But as I had mentioned, these are typically below market rate programs and certainly worthwhile looking into. And of course, there are specialty funders who just focus almost exclusively on financing energy efficiency projects. And I'm going to talk very briefly about PACE, commercial and residential, and the energy services, EPC, energy performance contract, the traditional ESA, energy service agreement, energy as a service, and power purchase agreements. So you'll notice that there's a little lightning bolt here for renewable energy, and that really deals more with the solar lease and the power purchase agreements. They fall into the category of renewables. I'm not going to spend any time talking about cash. Obviously knows that everybody knows that the cheapest way to finance something is to pay cash for it. However, once you do that, the funding that you use on this project is no longer available for other projects. And many organizations are really intrigued by income generating, income producing projects. Energy efficiency does not generate income, it creates savings. So when we're in a tight economy, savings becomes a driver. Maintenance responsibilities and project management, of course, falls on your shoulders, and that's true with a loan or any of a number of other type of financing structures where you're actually obligated to repay for the financing. Loan Pro, approximately the lowest borrowing cost, short of paying cash. Why is that? Because most lenders will require you signing a blanket lien, so you're committing to making hell or high water payments. And if you don't make the payment, you may have other loans. If you're dealing with the bank, for example, that could be called in if you default on one of the energy efficiency or any other loan. The investment tax credit goes to the owner. That's a big pro. Plus, and the cons, competes with other capital projects. How do we get energy efficiency out of competition with other capital projects? We'll give you some more tools on how to do that in just a few minutes. It reduces your credit lines, often has restrictive covenants. Usually it requires large down payments, typically 20% is a fairly common number. Internal politics, you can't get away from internal politics. That happens across the board. Maintenance and management risk, again, that's pretty much universal. Just a quick word about off-balance sheet. I'm not sure if you hear that when you're talking to your finance people. It used to be that organizations were looking for off-balance sheet financing. Why? Because when it goes off-balance sheet, it means that the company does not reflect the liability on its balance sheet. It's an accounting term, and it will impact the company's level of debt and liability. And that's certainly true, especially when they go to borrow additional funding. So what do they look for in terms of lenders when how you can benefit is avoiding additional debt. You can improve your financial ratios like profitability, return on investment, liquidity, your current ratio. Current ratio is current assets minus current liabilities. Leverage. Everybody likes to talk about leverage. And if your debt is reduced compared to your equity, and it's reduced because it doesn't show up on your balance sheet, it's off balance sheet, that will improve that, of course, efficiency. These are all things that when you enter into a loan, by the way, many lenders require you to enter into covenants. These are contractual agreements that you will maintain your profitability or liquidity ratios, et cetera, at certain levels. And if you can keep something off your balance sheet, that would be quite positive in terms of borrowing more money and making you look healthier from a financial analysis perspective. The Financial Accounting Standards Board, however, changed the rules in 2018. And while operating leases, for example, used to be considered off balance sheet, that is no longer the case. They now have created a special category, so you cannot duck that. Actually, that is a consequence of Enron. If you are old enough to remember the Enron fiasco, that's what generated these on-balance sheet, off-balance sheet restrictions and controls. So what's a type A or capital lease? Very traditional. It's similar to just a straight funding, borrowing. Gives you access to new credit lines. Some of the big advantages of dealing with a lease or any kind of a lease is the structuring flexibility that it gives you. When you're dealing with a bank or a more traditional lender, they like to have level payments over the term of the agreement. That's it. It's simple. Their programs are set up to deal with that. Bingo. However, if you're dealing with a lease and an effective leasing company or leasing group, it gives you the ability to structure the lease in a way that it reflects the way the energy savings are occurring within the project. So you can create step leases or skip leases. What is that? Is anybody breaking up? Is that correct? Can you hear me okay?
Yeah, we can still hear you, Neil.
Oh, okay, I guess I just saw a note there that's saying they couldn't hear me. So the structured flexibility, step lease, skip, what does that mean? A step lease is Very important as you're installing energy efficiency improvements on a large project, the energy savings that you're generating increase as you install more equipment. So if you want the energy savings to pay for 100% of the financing, then this allows you to step up your payments as you install more equipment. So it keeps it in line with the savings that are being generated. What is a skip lease? Skip lease is maybe you have seasonal differences. There was an, an amusement park that we did financing for in upstate New York. And they were basically closed wintertime. So we need utility to have them pay larger payments when they were open in the summer and they had cash flow, and just touch payments in the wintertime when they had no cash flow. So it was made in sync with their ability to be easier for them to pay back the obligation. Of course, 100% financing, not the case with bank loans, where you, as I had mentioned, you need to provide some kind of a down payment. Depreciation and interest is tax deductible, secured by the asset being financed. The lessee does own the asset at the end of the term, and the investment tax credit does go to the lessee or the building owner. Cons, because it's secured only by the asset financed, it may be slightly higher than a loan, the interest rates. So that's actually the big downside on the con, which is not a very big one. At any rate, type B, an operating lease, new credit lines, the structuring availability structure is still there, 100% financing. These payments can be tax deductible, which doesn't mean that they're off balance sheet. So there's a distinction here between an operating lease or a tax lease. See, an operating lease is what FASB would be guiding your accounting folks on, which is how does it appear in your financial statements, versus a tax lease is the way the IRS would look at it. So there are instances where you can have an enter into a lease agreement that must show up on your balance sheet, but you can still deduct it for tax purposes, which would be the tax lease. Important distinction between taxable and tax exempt leasing. Tax exempt means translates into lower interest rates. Well, why is that? Well, there's no federal income tax paid on interest earned. Public sector can issue tax exempt obligations, and that's a rule from the IRS. How is that determined? If you have eminent domain powers, taxing powers, or police powers, that any one of those three will allow you to qualify for issuing tax exempt financing. Curiously enough, there was an instance where a private university that had their own police force attempted to enter into a tax exempt lease. It didn't work. The IRS determined that it was a constabulary and not a police department. And therefore, the university had to recalculate all of the payments that they had made to the investor at a taxable rate, and that wound up causing them a huge increase in the financing cost in the project. So, make sure we dot our I's and cross our T's. Private sector launch nonprofits must go through a conduit agency to issue tax exempt. Example is a private university in New York State, for example. The Dormitory Authority of New York is considered a tax exempt entity, and a private university can enter into an agreement with the conduit agency in order to issue tax exempt financing. They will charge a small fee for doing that, but usually the fee is relatively small compared to the savings that you would realize on your interest rates. And public sector does not pay taxes. So it used to be you couldn't use tax incentives or strategies. That is no longer the case. And I have to put a red line through that here because that's the big change with the Inflation Reduction Act. What is a tax exempt lease and why is it cheaper? It's a lease purchase agreement. It's like an installment sale, conditional sale, gives you an option to purchase for a nominal value at the end. They're also referred to as a municipal lease. It's the same thing. It can only be issued by a state or political subdivision. cities, towns, school districts, special purpose districts, and some not-for-profits. Tax exempt interest rates are lower than commercial rates. Why? As I had mentioned, the lender doesn't have to pay federal income tax on the interest earned, and because of market competition, the people who offer this kind of financing will reflect that in the monthly payment that you have to pay. So your interest rates are lower. Gives you the same structuring flexibility, step lease, skip lease, etc. Does not usually require a referendum for approval. That's really a big point. I probably should put that in red. Because a private public sector entity, in order to enter into debt, usually has to have a referendum in order to approve that payment. But because a tax exempt lease contains a language in it that ties the payment to the annual appropriation of funds, that makes it, from a legal perspective, not debt. And because legally it's not debt, you don't have to go through the referendum that you might have to do, or you would have to do if you were issuing a bond. The true interest cost is usually lower than a bond for small to medium projects. However, if you have an energy efficiency project, you're going to be issuing a bond. Certainly, the bigger the project, the lower the total overall costs would be, and I would suggest that you add it to your large bond issue. But however, if it's medium or small sized project, you're probably better off treating it as a standalone. Lessee owns the asset at the end. And I have to change these because the ITC is no longer forfeited maintenance responsibility. This is an older slide from last presentation that we did prior to the ITC. Some changes coming to those slides. What's an energy services performance contract? Well, it's providing the customers with a comprehensive set of energy efficiency, renewable energy, distributed generation measures, often accompanied by guarantees or with guarantees that the savings produced by the project will be sufficient to finance the full cost of the project. It implies working with an energy services company or an ESCO. They like to do comprehensive measures. It's a turnkey service. They will provide project financing that is usually done through a third party. So in essence, what we're dealing with here is dividing the technical piece from the financing piece. The ESCO will do the technology, and the financial institution can provide the financing. Why is that? Because the financial institution, if they deal directly with the public sector entity, can issue a tax-exempt financing, versus if the entity is taxable, it has to finance it using taxable rates. So there's an advantage there to the end user. And of course, some of the cons with all of these agreements, pretty much the same con. Careful review of the contracts to make sure you're only getting what you need and what you want. Energy service agreements, a slightly different animal. It is one in which the equipment is owned and operated by the energy efficiency company, not the host. By doing that, it keeps the assets off the balance sheet of the host because technically they don't own it. So they're entering into an agreement in which they're paying for the service, which includes the replacement or the placing of the energy efficiency equipment. No upfront cost to the host, managed, maintained by the third party, and as I had mentioned, could be considered off balance sheet. Standard con, careful review of contracts, know what you're buying. There are variations. A traditional energy services company or ESAs where the equipment is owned by the ESCO, but the owner pays the utility bills, energy as a service. Now, this is a structure that's been around in Europe for probably 20 years, maybe even longer, but it's a fairly newcomer to the United States. We're kind of catching up with Europe here. But it includes equipment upgrades, replacements, managing bills, and they will suggest alternative energy sources. Good example of this, the way that was being used, for example, in Europe, and to a grocery store. The grocery store has an energy service agreement with a third party that they will maintain all of the produce markets and the freezers at certain temperatures. And that's the commitment, and that's the service they're providing. And there's the third one here, energy assets concession. It's much less common, requires a very long term and very large projects. I'm not going to spend time on that because these are mega $1 million projects that would be required in order to capture interest for the investors in those energy assets concessions. CPACE, very briefly, property assessed clean energy financing mechanism that enables low cost, long-term funding for energy, water efficiency, and renewable projects. It's a voluntary program. It has can pay for up to 100% of the project hard and soft costs. Terms can extend out to 30 years, which allows for deep retrofits. Now, if we're dealing with a lease company, for example, they like to keep their lease terms to 15 years or less, preferably 8 to 10. If you're dealing with a bank, they also want to keep the terms a little bit shorter, but if we're dealing through CPACE, there's a chance there you can go out to 30 years, which can be very beneficial based on covering more of the technologies that are being installed. It can be combined with incentive programs, and it can stay with the building upon sale. So that's a big plus. That's almost like off balance sheet. If the obligation stays with the building, then it's not technically on the balance sheet of the entity that is filing their income tax year to year. Some of the cons, it requires local and state enabling legislation. It may require first mortgagee approval, which means if you have a mortgage with your bank, they may have to agree to allow you to enter into this because it is treated as a tax. It's not treated as a loan per se, it's treated as a tax on the property. Just the way you have local public benefit assessments for sidewalks and sewers. So total loan amount is generally determined by the tax capacity. What is tax capacity? It's the level of taxation where the payer of the taxes starts to cry uncle because it goes beyond their ability to pay. Complicated formulas that are used there, and the interest rate may be higher, usually is higher than alternatives, but some of these pluses, pros, more than offset the negative cost of interest rate when you can stretch the terms out much longer in terms of cash flow. That could be a huge benefit for your organization. This is a map that I took from the pacenation.org website. And if you go to that website, click on your state, you can see exactly what programs are available for you within your state. Quick word about power purchase agreements. They're really a legal contract between an electricity generator or provider and a power purchase buyer. Typically includes electricity and hot water, and it is used a lot for renewable energy projects. Minimal upfront costs, gives you the potential to monetize tax incentives. Long-term energy price, you can lock into it. There's no or limited operations or maintenance responsibilities that falls on the owner. Minimal risk in terms of operations, that the equipment's going to do what they promise it's going to do. The cons, contract term limitation, they tend to go out pretty far. Excuse me. The transaction costs can be high or higher. Why? Because if a third party is going to enter into the agreement, they're going to take a second look at all of the engineering studies that were done in order to convince you to do the project. Why? Because at the end of the day, if it doesn't work, they're stuck. So they're going to want to make sure that the engineering is spot on. It takes longer time to approve it. That's one of the reasons why. Politics, again, can't get away from politics. And the terms and conditions may be challenging. There may be take or pay language written into it. So again, you need to drill down on these. A solar PPA, again, as I mentioned earlier, very sophisticated, and they're highly negotiated agreements. I'm not going to drill into that. They're all unique. They're done one by one. So it's important to, a little disclaimer here, the pros and cons are the most common ones. They're not intended to be all inclusive. So let's take a quick look at hurdles. I mean, how do you use financing to overcome challenges and getting to yes within your organization or your client? So let's take a quick look at the traditional operational hurdles that we find. Limited staff. I don't have the people to do the work. They don't have the expertise. This is not our business. It's too risky. I'm not sure if the equipment's going to do what it says it's going to do. Besides, I have other priorities. As I alluded to in the beginning, focuses on income producing projects, and it's not our core business. Why would I be spending a lot of time dealing with that if that's not what I do? I make shoes, for example. Some of the financial hurdles, too expensive. We can get cheaper equipment. We can get cheaper funding. However, if you get cheaper equipment, the savings will typically be less. The big one is can't take on new debt. Now here we're dealing back with the bank covenant bullet that I had mentioned earlier. So if off-balance sheet financing would have been the good answer for you, if you can't take on new debt, you need to look for something that could be considered off-balance sheet. Creditworthiness, market soft or financial performance is subpar. There are places you can go to, like your green bank, I mentioned earlier, to look for ways to get financial support so you can enter into the project. A return too low in a strong economy focuses on income producing projects. So I hate to have to compare an energy efficiency project to an income producing project. So if I can get an energy project off the list of capital projects within the current or upcoming capital budget, that's a big plus. One of the benefits of dealing with energy efficiency projects is they save operating savings, save operating dollars. And if you can structure the financing so that the finance cost is less than the savings that are being realized, everybody wins. Capital budget constraints, we just have to wait until next year. And I'm going to show you with our cash flow opportunity calculator exactly how to quantify that with that EPA tool. And payback too long. Usually, if you were in the corporate world, the investment thresholds are typically 3 to 5 years. Shorter is better. So if it's 2 years, it's even better. Energy efficiency projects don't tend to meet that hurdle. They tend to be longer, but the benefit is very different. They can provide you with the opportunity to have your cake and eat it too. So how do you use financing to address these hurdles? Well, here is an example, a chart. And again, you don't need to write this all down because you're getting a copy of the presentation. So if you have operational challenges, you really want to look at the types of vehicles that are involved, performance contracting, energy services companies, because they're the ones who are going to provide the manpower to help you deal with some of those. However, if your challenges are financial, well, if it's too expensive, you can basically deal with pretty much any one of those options there. Can't take on new credit, you can look for an operating lease, which in today's market may be difficult to deal with, or power purchase agreement, base, for example, or an energy service agreement. If you have credit worthiness problems, I'm going to point you in the direction of PACE and green banks. Return is too low, as you can see. PPA works. ESA, excuse me. ESA works and PACE works. Capital budget constraints. I'm not going to read through the slides there or the bullet points. You can read it for yourself. So let's take a quick look now, changing gears totally away from the financing structures into how can we sell energy efficiency improvements when you've got a client who's reluctant to do it, or you've got an internal organization that's reluctant to sign off on it. And there are 3 different opportunities here to look at. The financial value calculator, which quantifies the value of improvements in energy efficiency to your organization, and it uses prevailing price earnings ratios to estimate the market value of increased earnings that can result from increased energy efficiency. What do we mean by that? Commercial real estate, for example, if it's being sold, one of the guidelines is to look at the cash flow that's being generated by the property, and the value of the property is a multiple of the cash flow of the property. So if we can improve the cash flows within the property, in essence, what we're doing is improving the value of the asset itself. So this calculator will help make that calculation for you. Building upgrade value. Well, this evaluates the cost and benefits of energy investments for both the owner and tenants. This is important because one of the big challenges we see again and again in doing energy efficiency projects is where the owner of the property would have to make the payments to do the upgrades, but it's the beneficiaries, the tenants, who receive the benefit. So how do we bridge that? Well, this calculator, the building upgrade value calculator, has a series of exercises that will walk you through how to justify and share these benefits between the owner and the tenant. It's very helpful, certainly dealing with the split incentive barrier, and it's worth taking a hard look at. What I like personally is the cash flow opportunity calculator, and this is answers 3 questions. This is the one that I mentioned that I was directly involved in writing a lot of the algorithms for. How much new energy efficiency equipment can be purchased from the anticipated savings? Should it be financed now, or is it better to wait and use cash from a future budget? Or will we lose money by waiting for a lower interest rate? That's a little more esoteric. But what this cash flow opportunity does is it calculates the cost of delay. And I would really like everybody to read that little phrase. I don't have to hear you say it, but on the count of 3, read it yourself. And 1, 2, 3. Paying for energy efficiency projects, whether or not you do the project. But what do we mean by that? Well, if you've got a lot of energy inefficiencies in your utility bills, if you do not make any effort to do the improvements and reduce your energy consumption, then you're going to continue paying those inefficiencies to the electric and gas and water utilities. So you'll wind up paying for it. And I can tell you that the utilities will not refund those dollars. They've earned it. They provided the services and the energy and the water that they promised they would do. So how do we deal with that? Well, we go into and you download the cash flow opportunity calculator that will quantify the cost of delay. And as you can see on the bottom here, I've got little tabs. It's built on an Excel spreadsheet. In production, there's an instruction tab, data entry tab, investment value, cash flow, interest rate tab, and a summary. So as we go through this, it builds upon itself and starts with there's an instruction page there. I'm not going to click on that. You can look on that, look at that yourself. So the data entry tab, anything that's in yellow is a field that can be overwritten. Anything that's in blue is a calculated field. So we start with entering your organization's name, and you would pick the kind of analysis. So we started this tool for the public sector organizations like schools and municipalities who are constantly short of operating dollars. I mean, they're really running operations on a shoestring. So they were the first ones to say, we can't afford to do energy improvements. And we said, yeah, but no, you don't understand. You've got golden nuggets sitting in the hallways. We just need to be able to know how to dig them out. And this tool will help you help you dig it out. So the first thing we want to do is decide what methodology we're using in order to convince the end user or the organization to do the project. So if we're using a green building arguments with LEED, there are modifications to the tool that uses green buildings language. Water, wastewater treatment. We used to deal only with public sector organizations until we got to the water, wastewater people, and they said, no, you don't understand. We don't measure energy efficiency by square foot. We measure it by millions of gallons of water. Dealt with other organizations that deal with building types, building upgrades, tune-ups, and of course, manufacturing facilities that measures energy by widget cost. So you make that determination, you click on the one that you desire, the one that best fits the way you're marketing to the client, so that this tool, in essence, translates your savings into dollars and cents consistent with the proposal that you're making to the client. So in this example, as you can see here, we've got, XYZ commercial properties. We're using benchmarking results from EPA's portfolio manager. And actually, that's something that I forgot to mention. When we go back to the retrofit alternative measures for the 179D tax deduction, it used to be that you could not, you couldn't do, you couldn't get the benefits for retrofits. Now you can. And how do you measure energy use intensity? Guess what? EPA's tool, the Energy Store Portfolio Manager, is an acceptable methodology for that. So if we're using the portfolio manager, you'll pull the information off of that tool and it goes into the 4 quartiles, 75 or better, 50, 74, etc. So you can input all of the detail from your particular facility organization into the tool. And what we're doing here is we're setting up the basic guidelines. What's your annual current utility cost per square foot calculated? What do we project the savings to be? Well, it's going to depend on, the technology, and obviously it's going to be harder to save when your equipment is performing well, and it's easier to save when you're dealing with underperforming areas. So you give those guesstimates, and as you can see here, it gives us a weighted average. In this example, if this project on $1 million, a million square foot, $1.5 million annual utility budget is properly installed and working, it will save us 28% of our utility bill, which translates into $425,000. What are we going to do with that? Well, this is the magic word, leverage. So we're going to take that 425 and we're going to leverage it to see how much we can buy from it. As you can see here, we're taking the calculations that we just did on the first tab, laying it in on top so you can see how the tool builds itself upon itself. And in order to leverage that, we need to add some additional data, starting with what's the interest rate. Here, for argument's sake, they put in 7. We have to enter a term, 10 years. How much of the savings do you want to use to pay for the energy improvements? I'm going to use 90% here. We dealt with one school district in the West Coast that they had lost funding for teachers, and they wanted to use part of the savings from the energy efficiency project to re-engage, rehire some of the teachers. So they have the ability to play with that number. And of course, are there any incentives, rebates, etc., that we can add to it? So once we enter that core data here, we go over to the calculate button, push the green button, and it will give us how much energy efficiency equipment we can buy from the savings that are being forecasted. So in this case, $2.8 million worth of new equipment can be installed without increasing the operating budget. And this is outside of the capital budget of the organization. This is in addition to. So this is being funded by the energy savings that are being realized by the equipment itself. Of course, we've done some other calculations down here with regards to, simple payback how the savings are contributing to the overall budget, et cetera. But that goes without saying. So let's click onto the next tab. And this is the cash flow tab, and this happens to be one of my favorite tables on this particular tool. Again, you see that we're building from the data that we just entered in earlier. So like a little important note. So if you can change the input on any one of these input areas here. However, if you're going to use the general report at the very end, the summary report, it's going to not function properly because it's going to have different numbers in it. So you'd have to go back to the very beginning where you started entering that data at any rate. So what do we have here? Restatement of the earlier information, and we need to add some additional data here. So if the argument that we typically heard was, no, we can't afford to do it now, we're going to wait until next year. So we're going to wait until next year's budget, and then we'll do everything, because that's when we can afford it. We hate to take out money. We don't like borrowing. We hate paying interest. All right, well, in this example, we're going to postpone it for 1 year. The project cost will increase because of postponement, and I'm assuming a 4% inflation. The energy costs, I'm assuming the energy cost is going up. In today's market, that may or may not be the case. So at least you can go in here and you can change these numbers. You can actually put in negative numbers if you think, the energy costs are going down. The tool still works fine. And because the University of Pennsylvania looked at this tool with us, they said, hey, what do you do when you're dealing with the school and you've got students in the classrooms? You cannot install all of the equipment at once. You have to parcel it out. So they said, give us the opportunity to do a partial savings in the first year, which we'll give you the opportunity to enter into here. What you think is going to happen if the savings must pay for the energy efficiency improvements. So what comes next, and this is the cash flow considerations, and I'm a big cash flow guy. So let's look at the consequences on our cash flow. What's our savings? Where does that come from? Well, you remember that came from the very first spreadsheet when we did our how many square feet, the total utility budget, the savings projections. So this is the savings divided by 12. Project costs, well, that's the financing based on the interest rate and the term that you plugged in the prior tab. It's monthly payments amortized to zero over the term of the financing. And of course, you subtract the savings from the cost from the financing. It tells you if you have any out-of-pocket exposure here. So in this example, year 1, yes, there is some negative out-of-pocket exposure. So the savings are not paying for 100% of the project. But as you can see, as we move forward, we have positive cash flow in each one of these years. And we're going to compare that financing to option B. We're going to wait until next year to pay for it in cash. Well, what does that translate into? Well, you're not going to get any savings, so you continue paying to the utility. Your project cost didn't go up because you haven't done it. Annual cash flow, everything's zeroed out, as you can see here. But what happens if we do the project next year? Well, your savings have been already calculated on the first tab. That hasn't really changed. Your project cost is the cost of buying 100% of the equipment. Take a drink of water here, excuse me. So as you can see here, the cash flow is pretty substantial. You got to come up with $2.7 million in year 2. But every year after that, you keep 100% of the savings because we hate to pay interest. We hate it. We don't want it. It's not good for us. It's a bad thing. Well, guess what? What is a better financial decision in this case, in this example? Is it better to finance and pay interest, or is it better to not pay any interest and keep 100% of the savings? Well, here's the answer. Take the net present value of the annual consequences and the net present value of fast track financing, $688,000, and the net present value of waiting for cash, $404,000. I will tell you without any hesitation, your financial people are probably not looking at it this way. This is counterintuitive to most financial folks within the organizations. So this is a very important tool, and it confirms that the financing will generate more cash benefit to your organization than waiting and postponing the installation. Cost of delay is an expensive decision to make. In this case, 70% more expensive than entering into a financing. Let's take a look at the next tab. Well, excuse me. Reminded that one school that I talked about earlier out on the West Coast, they had a 5-year build-out program for their energy efficiency projects. If they delayed it for 1 year using those numbers, they would have lost $284,000, equal to about 10% of the project cost. If they delayed the installation for 2 years, it was equal to 24% of the project cost. I mean, these are substantial numbers. Again, not the way most financial folks look at it until you guide them, help them understand it, help them see this, and you'll find that everybody benefits. Needless to say, the school district took their 5-year build-out program and engaged more energy services companies to accelerate the overall project. The last tab here is the interest rate tab. This is a little more esoteric. If they're being offered a financing that you could do today at 7%, but they come back and they say, no, you don't understand. We can borrow much cheaper, 4.5% in this example. Why would I do your 7%? Because the interest rate I can get is much cheaper. The answer is, or the question is, how long do you have to wait before you can access the cheaper interest rate? So that's what this calculator does. It calculates the difference between the higher interest, lower interest rate. What is the present value benefit of that? And as you can see in this example, if I can do both loans on the same day, definitely go for the cheap rate, because I just saved $342,000. However, if I have to wait to get that cheaper money, every month that I wait, my inefficiencies go back to the utilities. And as you can see here, what is the break-even point here? 9.7 months. So if you're looking at a project, and we're going to wait because we're going to add it to a bond issue next year, well, even though it's only almost 10 months to break even, you're better off entering into the loan agreement. Now, one example where I actually use this is we were working with a lighting manufacturer vendor and a Fortune 50 company in Chicago. And the building was owned by the Fortune 50. And I was dealing with the manager of the property, who was an employee of the Fortune 50 company. And he said, no, you don't understand. I can, if I wait until next year, I have access to our capital budget, and they're going to charge me back, but the chargeback is considerably lower. I said, great. Let me ask a question. Do you get a bonus for managing the property? Well, as a matter of fact, I do. And what is the bonus based on? Well, it's based on cash flow of the property. Oh, so if we improve the cash flow of the property, not only does that improve the value of the asset, but how might that affect you? Guess what he did? He entered into the loan agreement. So there you go. You never know what is on the other side of the question. That was a calculated risk that I did, and it worked out well. That again is counterintuitive. Cash flow opportunity, the summary report I alluded to or mentioned earlier. If you change numbers as you're going through the calculation, this report will not work. You have to change the number, the first place where you entered it in the process here. And of course, one of my favorite standalone printouts, let me go back for a minute, is this. You can print this tab out by itself. You can print this out by itself and just attach that to your presentation and just argue the cash flow component. Where do you get the tool? You go to epaenergystar.gov, click on commercial building section, as you can see in the upper right-hand corner. Get down to look for resources by topic. Click on that. It'll give you a directory. Go down to F, click on financing, and there you go. You'll find the category to evaluate the economics of energy efficiency projects. And this is where you will find a lot of the tools that I just shared with you today. Certainly the cash flow opportunity calculator is there. If you think that the CFOC or cash flow opportunity calculator is beneficial, you want to use your own numbers, there's another piece that we wrote that gives you all of the details so you can create your own tool. This is not a magic to do this. It uses very simple calculations, simple math and net present value calculations. But if you download the paper evaluations and methodology, will give you step-by-step instructions on how to create your own. So you can download it from this tab here, and I'm going to finish today's presentation with that on the CFO calculator. We would ask you, because we're always looking for opportunities for bragging. So if you have a case study that you think makes sense, that you'd like to share with us, please let us know. Contact either me or Kudret, and we'll be happy to pick it up and see about how we can turn that into something that potentially could be posted to the EPA Energy Star website. So I have a list of some additional resources here. Green banking, on-bill programs, getting to yes for energy efficiency. This is an article that we wrote in conjunction with the Energy Office in Maryland, and it details very specifically how the financing structures that I had outlined today can be used to offset some of the concerns. Financial ratios, lease standards, PACE, go all the way down, but the one I want to point out is here. That is a hot link. But if you're looking for the Inflation Reduction Act updates, click on that link, goes to the US Department of Treasury, and you search on the word energy. It will give you all the latest updates as to what's going on within the IRA world. And with that,